Welcome, everybody, to this week's installment of Root Roundtable. I'm your host, Jay Withee. We got our disclosure up. We got to post this for at least 10 seconds. Make sure we don't upset our compliance officer. She's trying to take care of us. Make sure we're in the rights here. We have such an exciting show for you guys. I am so pumped about this week because I talk to prospective clients every day and I hear the questions, I hear your concerns, and I'm going to introduce you guys to my guy, Brooks Palmer. So, Root brought on Brooks Palmer a couple months ago as our head of investments. Was a big move for us. This was really exciting. And Brooks, I'm going to give you a little fun fact about Brooks. He is a graduate of UNC. You know who else went to UNC, Brooks? Michael Jordan. And I was thinking, I was like, Brooks is our Michael Jordan, dude. That's really is. He's come to help guide this ship and create investment strategy for us. And so he's our Michael Jordan. I love Brooks. He's such a great guy. Brooks, do a little intro for us.
Yeah, absolutely. Jay, appreciate the kind words, and I'm excited to be here today. Should be a fun little session that we've got in store. I joined Root 2-3 months ago, came over from Dimensional Fund Advisors. Some of you that watch or tune into the Root stuff on a regular basis, you'll be maybe familiar with Dimensional. So I have some background there and at some other wealth management firms as well. But I'm located down in Austin, Texas, so things are heating up down here. But we've got a great show in store, and excited to be here, excited to be a part of the Root team. Obviously, we've got a great thing going, and hopefully we can give you some perspective on what's been an interesting few weeks in the markets, Jay, to say the very least.
To say the very least, my good friend. So, you guys, that's the concept of this show. I'm on calls with a lot of people every day. Look, I'm invested in the market, right? So when things like this happen, market volatility, whatever you want to call it, bear market turns like this, instability, it's naturally concerning for a lot of people. Now, there's a lot of people that have been invested for a long time and they've seen the ebbs and flows and, they're more comfortable and it's okay. They kind of know things will rebound in the end. But for a lot of people, it's natural to feel scared, nervous, uncertain, right? And so a lot of people ask me, hey, Jay, like, I love what you guys talk about, Root, with this holistic approach. It feels so hands-on. You have this high touch level of service. But, one of these questions like, so Jay, what, a lot of people want to know about investing, right? Our investment strategy overall. And Brooks has gone on Ari's live show and really talked about how we approach that. It's incredible. So I recommend you guys go back and watch that. But now a lot of people are asking me like, Jay, what can I ask? Like, what do you guys do now, right? In these times of market volatility, what's Root's position? Like, do you guys have a strategy or you set it and forget it? And I was like, who better than to help talk about this than our main guy, Brooks? Because, what's cool, I was talking to Brooks about this earlier. What's cool for me about being an employee of Root is I actually get to see what's going on in the background. So we have different forms of communication, but like one of them is we use Slack. So we have an investing channel. And as soon as we heard about the tariffs and the market started dipping, Brooks was right on it, right? He's communicating to all of us employees, especially our advisors, about what's happening, right? We understand something happened. Now, what are we going to do about it? What strategies are we going to use? How are we going to effectively communicate to our to our clients, right? And it was so cool to watch that, like action, right? We took action right off the bat. And so I said, let's have Brooks come on and let's hear it from the horse's mouth, right? Because people want to know, what do we do during these times, right? How do we communicate this to our clients? So let's start off there, Brooks. Simply, like, why don't we walk back to when this kind of happened over the last couple of weeks and how you went into action?
Yeah. So I think it's a great distinction, Jay, because on our side of things, we have a plan in place before things like this happen. And I often talk about it as, proactive financial planning. Obviously, I'm more investment focused, but before anything like this happens, it's like, hey, if we see the market go down for one reason or another, here are the things that we might consider, depending on your financial plan, depending on your situation, all of those caveats. But there's some very key or critical elements that we can consider to put you in a better position potentially down the line. Then nobody wants to see the market go down. But at the end of the day, there's some key things we can do. So let me share my screen here, Jay. Let me see if I can get
let's do it.
And the key part about this, as we continue to mention, is that no one's excited when the market goes down, right? And I think that screen share should be coming through okay. Is that right, Jay?
Yep, it's popping through. We can see it. The market downturn, do's and don'ts.
Yep. So some of you might have seen this. Ari shared it a couple of times. We put this together actually before, it was about a month and a half ago. And this is one of the things where we had this plan put together, but let's put it in a sheet and let's talk about it as a team. What are we going to do if the market does go down? We weren't making predictions about what actually played out. Unfortunately, it happened sooner rather than later. But there are some key things that we can consider. So one of them, tax loss harvesting that you see right here. That was one of the very first things we started to talk about. As the market goes down, unfortunately, and we experience a little bit of pain, let's see if we can realize some losses in the portfolio, meaning we're not selling out of the market. What we're saying is some of our positions have gone down. So depending on the situation, depending on, various client situations, we might consider selling that security and trading into a similar one. So that's one thing that's on the table. Examine potential Roth conversions. That is more of a tax strategy. I don't want to go into it too much, more on the planning side. Our great advisors, they look at that a little bit more in depth, again, depending on the client situation. And then also one thing that we talked about internally, this is a prime example internally and with our clients. This is a prime example of when we lean on our root reserves. And root reserves, in case anybody's not familiar.
Yeah, let's share that.
Is that bond allocation. So we own a lot of stocks and we love stocks. And our clients, we believe long-term that they should have a higher expected return than bonds, but bonds play a very important role in a portfolio in that a lot of the folks we work with are retirees or close to retirement. They need to be able to meet certain cash needs in the short term. What better to do that than a very high quality, I shouldn't say safe, but a high quality fixed income allocation, a bond allocation. So there's really, when you think about financial markets, there's all different types of investments out there, Jay. I mean, you've seen thousands of them, but at the crux of it, you can own companies or you can lend to companies. You really have two options. And when you think about lending to companies, that's what we're doing with our root reserves. And again, it tends to be, shorter term, higher quality, but we really want to be able to meet immediate cash needs. And so this is when we start to draw on those. Instead of saying, hey, the market's not always going to go up. We wish it did. But in times when it doesn't, we can draw on those root reserves.
Brooks, I call root reserves, I say that's break glass in case of emergency, right?
Yeah, that's exactly right. And then we'll get into a little bit more of this around our communication with clients to ensure, they're still getting the most out of life with their money, that they're aware that uncertainty is kind of built into the financial plan. And if we need to have a conversation, which we've had a couple, just around downturns and recessions and recoveries, we can certainly do that. But I think, Jay, just scrolling down a little bit further here, what we don't want to do is abandon our investment approach. And what is a huge pet peeve of mine is I'll go on, LinkedIn or go on CNBC or something like that, and I'll see all kinds of people that are investment professionals claiming that they've taken a defensive posture or they're going risk off or they have some other kind of jargony term for it. And it drives me nuts because it sounds somewhat attractive to people. But what a lot of folks don't realize is that the anxiety of being in the market, when you decide to bail out and maybe sell out of the market, even to a small degree, that anxiety of being in the market is quickly replaced by the anxiety of being out of the market. When am I going to get back in? When is it going to be the right time? And that's such a tricky game to play. And man, that jargon, it sounds so seductive and attractive to people. But again, that anxiety is quickly replaced. It happens time and time again. couple other things here. When we look at things we won't do, we're not going to adjust client portfolios based on predictions. We could ask 20 different people on the street, and if they told me what they thought, the tariffs were going to be 90 days from now, I would say every single one of them is wrong without even knowing what their guess is, because
Exactly.
nobody knows what's going to happen there. And then, a couple other things, but this one towards the bottom, I want to spend a little bit of time on. We really try to prevent emotions from getting tangled with investment decisions, because when emotions start to seep into your investment decisions, that's when things can get really, really tricky really fast. So we try to disentangle those for clients. And there was one thing that I wanted to share on that front, Jay, but before I do, I'll just stop my screen share real quick and see if we had any questions or if you had any comments, because I think it's worth going into a little bit of the emotional side and the behavioral side for just a second.
I do too. I agree with that. And, it's funny. I talk to people every day, and a lot of people are trying to plan for retirement, right? So maybe they're within a year, maybe they're within a couple years. So obviously, naturally, a lot of people are freaked out to see their portfolios dip down, right? It's scary, especially when you're saying, "Oh, how's this going to affect my withdrawal strategy?" Right? I'm trying to retire right now, so there's emotion to that. I talk about Brooks a lot about the emotion, like the behavioral science of retiring in general, right? So one of the biggest mindset challenges to get over is this idea from accumulating your whole life, right? And then you're saying, okay, now in retirement, I'm not accumulating. You want me to spend, right? That's really hard. So now you add the market volatility, and I get it. Like, people are like my own mom who's retiring right now, right? She's worried about this. She's thinking, oh my gosh, my portfolio is shrinking. I'm trying to retire right now. Do I have to go back to work? I hear that a lot. Do I have to go back to work? So, that's what I'm hearing, Brooks. And I totally get that.
Yeah. Yeah. And that's where, back to your point, Jay, I mean, this can be very painful, and it is painful. When I log into my brokerage portfolio or my investment portfolio, I don't like to see the market down 15%. It's painful. And I can't even imagine, a lot of our clients that we're talking to on a daily basis, to your point, they're nearing retirement or they're in
Yeah.
retirement. And
Yeah.
so the question is, well, how long is this? It's the $1 million question or the $1 billion question. How long is this going to last? And am I going to be okay?
Yeah.
And we don't have a crystal ball. I mean, the reality is that nobody knows. But one thing that we often talk about with clients is we can show all the data, we can show all the charts. And most of our clients, or the people on this call, that they've seen the charts, right? They know what they should do when times like this occur. But it
Yeah.
doesn't take away from the fact that it's still really painful. And
Yes. Good
so
point.
often what I talk to our clients about is, what I'm asking you to do is actually counterintuitive. And Jay, I mean, one thing we were talking about before this, if I put my finger on the stove and it's burning hot, what am I going to do? Man, I'm going to take it off as
Take it
quickly
off.
as,
Yeah.
right? And so it's this idea that when we experience pain as humans, we're going to try to avoid it. We're going to react. And so it's very intuitive. When I see my investment portfolio down 15%, my immediate thought is, I need to react. I need to do
Yep.
something to remedy this. And so let's acknowledge that. Let's acknowledge that you're human, and you having a reaction to this is human. I'm not going to ask you not to be human. What I'm asking you is to acknowledge that reaction is something you'll probably have, but let's see if we can shift our mindset. And there's this great quote from this guy named Walter Deemer. And the quote is, when the time comes to buy, you will not want to. And I know it sounds so simple, and I would almost exchange those words a little bit and just say, when the time comes to stay invested, you will not want to. And it's worth just like repeating that to yourself. And sometimes, I'm going into client portfolios and we're doing tax loss harvesting. We're doing something like that. And I'm sitting there telling myself, or I'm doing it in my personal account, and I'm saying, when the time comes to buy, you will not want to. When the time, and it's like, I got to repeat it to myself. So even for somebody like me, that initial instinct is to avoid pain. It's to avoid something like, I don't want my portfolio to go down 15%. But we have
No.
to keep, a lot of that data, and we can share some of it here, in mind, and know that we don't know when this is going to end. We don't know what the future holds, but we think it makes a lot of sense to stay invested. There's all kinds of studies on this. And so how can you get yourself to just shift that mindset a little bit and think back to, okay, if I went back 6 months ago and you told me that stocks would be down 15 or 20%, I would have probably told you, Jay, sign me up, because I want to buy during that time. But now, with the caveat of, oh, it's a different environment, there's so much uncertainty, all of these things, I'm questioning it a little bit. That's a very human reaction. We have to keep that in mind. Yeah. But at the end of the day, I continually remind myself, when the time comes to buy, you will not want to. When the time comes to stay invested, you will not want to. I need to almost override that initial reaction that I have. And that's something we talk to a lot of clients about.
Brooks, let's talk about, okay, another question I get from people, a baseline question, really important question. Jay, in the Sequoia process that you guys do, I see that I get to talk to my advisor 4 to 6 times in the first couple months. So you get to know your advisor pretty intimately. And that's great, right? Because we're rolling up our sleeves, we're doing work. Moving forward, Jay, after the Sequoia process, what's the cadence? How often do I get to talk to my advisor, right? So that's a huge question. But now it's funny because a lot of people are saying, Jay, how do you guys communicate to us clients when things like this happen in the marketplace, right? And I take from my own personal experience, which I shared with you earlier, Brooks, is like I had an advisor, right, from LPL, and I used to get these anytime something like this would happen. I felt like I got this like company generated newsletter that all the advisors send, which basically says, hey, the market's volatile right now, obviously because of X, Y, and Z. But in the long run, we always know that the stock market bounces back, and basically don't be worried. And I get it, because there's obviously truth in that. But if I was really anxious and really nervous, I don't think that would be good enough for me, right? And I'd want to be like, okay, but why? Why should I be calm, right? Because some people need a little bit more help understanding or hand holding or high touch services like that. So, part of me bringing you on there is I wanted to talk because I'm seeing it in the background, but like, how are we communicating with our clients, right? What's our approach?
Yeah, absolutely. Well, I mean, a couple of things. One, I think that far too many advisors out there, or just folks in the industry, tend to take it for granted that their clients are okay. So we want to almost over communicate. And maybe for some people that's not the approach that they prefer, but I think we would err on the side of, we want to make sure that our clients are aware of what we're aware of, right? Like, they know, they're feeling it. They know and are watching the news. Unfortunately, we tell people all the time, hey, put your stocks in a drawer and never look at them. That's one thing that I try to keep in mind. Put your stocks in a drawer, don't look at them. You'll be better off that you did that, by and large. But we know that's not the case. And so when things like this happen, we want to over communicate. And James, obviously the founder of Root, sent out a video to all of our clients. It included some language for me just on, hey, here's what's going on in the market. Here's how we're thinking about it. And also, you could hopefully tell in there that it wasn't generated by, some, template thing. It was like, hey, actually, here's what we're doing. Here's the Root reserves, how they're playing a role, all of those things. But in addition to that, I think that it's really helpful from our standpoint, when you talk about that Sequoia process, that 6-step process, we can always reference back to the things that we touched on in that meeting. And that's what's been so encouraging to me, Jay. And I know you've seen this as well, is that we've had clients reaching out to us and encouraging us and saying, hey, I remember what you said in the investment meeting. I remember what you said in the income meeting. And that's sticking with me right now. And it's very gratifying to hear, comments like that from clients. It just tells you the impact that we're having on people. But in the off chance that, hey, somebody's getting a little worried, they don't love what's going on, there's always the option, to set up time. And our advisors, again, have taken that idea of over communicating. And I've been involved in a couple of those conversations just about, hey, let's revisit the plan and let's talk about how this impacts or doesn't impact your plan. And that's where really taking that approach to holistic financial planning, in my mind, comes into play, right? Because if you're doing holistic financial planning and you're taking into account, hey, there's going to be dips and swings in the market. There's going to be downturns. We know that's going to be the case. It's just the way the market operates.
Yeah.
That is a part of the plan that we put together. And again, people hear that time and time again, but if clients want to revisit that plan and talk through any potential changes, not based off of what's happening in the market, but based on their individual situation, it's always an opportunity to do that. And Jay, there's one other thing here. I don't know if you want me to share this right now. This is one of my favorite pieces, just around like one thing that I shared in a client conversation.
Absolutely. Let's share it.
Okay. Yeah. So let me pull this up again.
Yeah. While Brooks is pulling it up, it's to your point, not to get too salesy with about, Root and how great we are, but, I had kind of a pulse with all of our advisors, and I was talking to our advisors over the last couple of weeks asking, hey, are you guys fielding a lot of phone calls? Are you seeing a lot of anxiety, nerves around what's happening? And honestly, a lot of our advisors are like, no, actually, our clients it's been very calming. And James and Ari did a great piece, I think it was last week, about it, and saying, look, one of the reasons is because of this holistic process, this Sequoia process, the lenses that we look through as advisors and educate our clients, and that high touch service, they are equipped with a plan, right? They
Yep.
understand what's going on. So their fears are at ease a little bit, right? They're a little bit more calm than someone who maybe doesn't talk to their advisor that much, right? Who doesn't provide that depth and breadth in explanation. Like what I always talk about is that's call it the Sequoia process. That is very intentional. It's intentional to give our clients clarity and confidence in the game plan, right? And so I think that's a huge piece of the puzzle. And that was really eye-opening for me to actually see in real time that that high level touch works, right? And it helps calm people's fears. So just a testimony to that.
Yeah, absolutely. Jay, I think
let me share it for you right here.
Okay. Yeah, here we go.
There we go.
So this is one just quick stat that a lot of people aren't as aware of. And this is looking at annual returns, S&P 500, 1926 to 2024. Everybody says, okay, that's a really long time. Tell me about what have you done for me What have you done for me lately, Jay? The S&P's done a lot for us lately. But if you look in here, only 6 years had returns near the average. What does near the average mean? So everyone here knows that, we start talking about stocks. It's like, hey, you're looking at 10% per year, and they just bake that into their head. But what a lot of people don't realize is you have to dig in just a little bit further to see that there's only been 6 years where the actual return of the S&P 500 index was within 2 percentage points of 10%. So
wow.
I often refer to this as the uncommon average, right? Everyone thinks the average is extra common, right? You're going to see 10% on a regular basis. You are not going to see the S&P return, at least historically, 10% hardly at all. It's typically way above or way below. So my expectation is not, if you were to ask me to give a forecast any given year, Jay, for the S&P 500, I'd probably say 10%, but I would know that my forecast is not going to be anywhere near that number more than likely, because it's either going to be way above, which you can see, all of these up here, all of these outcomes that were well above 10%, or it's going to be way below where you see a negative outcome down here. And maybe we end up, somewhere in this negative territory. That's part of the deal when you're investing in the stock market, unfortunately. But that, we talk about that as the price of admission. And I say the price of admission because I think about that. So many people think about it as a fine, right? They think about it as like a fine that you should avoid, like a parking ticket. Like, oh man, I shouldn't have gotten that parking ticket. To me, the price of admission is I'm paying to go to the theme park. I'm paying to go to the sporting event. I'm paying to go to a movie. It's part of the deal. We don't question, hey, if I'm going to go watch the LA Kings play hockey, I'm going to pay, $50 to $100. That's just the price of admission. So it's not something to be avoided. I think that's a very clear, we want to make that really clear. This volatility, these negative swings that we see in stocks, It's just part of the deal. It's part of the price of admission. Don't view it as a parking ticket. View it as the ticket to watch the LA Kings play hockey.
That's a great, I love that analogy because, yeah, don't be scared of the volatility, basically. It's natural. It's part of it, right?
Yeah. And the other part of this, Jay, that to your point on a lot of our clients, retirees or very close to retirement, worried about time horizon. And again, I think that is a very legitimate worry and something that we really take seriously here at Root when you start talking about Root reserves and all the financial planning that we're doing around cash flow needs.
Yeah.
But also, I think people underestimate how much of an investment time horizon they have, even when they're close to retirement. And what do I mean by that? Well, even if you see a market downturn early in retirement, as long as you, again, have put together a robust plan, you can give the market time to recover. And so people, a lot of folks, a lot of even our clients underestimate how long of a return horizon they have. Even when you're talking about retirement, for a lot of people, that's 10, 15, 20, 25 years that they could potentially be retired. If we give the market time, at least historically speaking, we expect a positive rate of return. There's no guarantees, right? But that's what we expect. And if you look historically, the more time that you've given the stock market to recover, it has greatly benefited your portfolio. So don't underestimate, even if you're close to retirement, how long of a time horizon you have. But that also emphasizes the need for really solid, holistic financial planning and a robust investment allocation. Excuse me. So
I agree.
You got to make sure that everything's in place. But I think that's another really key and important point that sometimes gets glossed over when we start talking about all of these things.
All right, Brooks, I got an idea. Why don't I have a couple questions. I have a couple good questions for you. Let's show Jill's. So Jill says, I'm new to bonds. How does a bond fund work and why is it safe? Why would I want to encourage more government debt by loaning to them? Great question.
The second part of that question, we might leave that one on the table. That's a great question. But if you're new to bonds, so I want to be careful with the word safe. And if Alex is on the call, our chief compliance officer, she'll be glad that I mentioned this caveat. But if you just think about what I said with the two options that we have there. So when you think about how to deploy capital, very simply, there's really two, if not three options. You can buy ownership stake in a business, which is what we do with stocks. You can loan money to businesses or a government. That's what we do with bonds. Or you can buy real estate. We'll put out that category just for a moment. So either we can buy businesses or we can loan to them for simplicity's sake. Well, loaning for them, often people will talk about bonds as a negative art. And what do they mean by that? Well, the best case scenario when I loan you money, Jay, is what? You pay me back my money plus interest. That's the best case scenario, right? So when we talk about bond funds or bonds being a little bit safer, what we're really referring to is that the best case scenario and ideally the worst case scenario, it's a little bit of a tighter range of outcomes versus if you own a company, if you own stocks, then that range of outcomes gets quite a bit wider. Because if I own a business and it's a great business, or if I own a set of businesses and they're great businesses, it could grow to the sky. And I could have, profits that are tremendous. And so my stocks go way up in value. And so you just have to think about it from those first principles. But at the end of the day, the mechanics of a bond fund, a little bit tricky. It's just at the end of the day, it's just a collection of loans that you're making to either the government or to corporations. We think, to your point, Jill, it makes sense to have a mix of both. So that's typically what you'll see, again, depending on the client portfolio, depending on their risk tolerance and everything like that. But we think it makes sense to have a mix. And they behave differently than the stock market. The real kicker is that when you look at your bond allocation, typically it will behave quite a bit different from your stock allocation. So ideally, you can structure a portfolio that when your stock allocation is up or down a lot, your bond allocation isn't moving nearly as much. And that allows you to draw on that or lean on that when your stocks might be down or up tremendously or something like that. So they behave very differently from one another, ideally. And that's why it makes sense to have potentially a combination of both.
So, okay, for Jill and, the listeners out there, what's happening with bonds in real time right now? Like, I know we're on a rally right now, but in the last couple of weeks when the market was very volatile, what was happening with bonds?
Yeah, good question. So I want to caveat this by saying that we're talking on Monday, April 14th. So if you look
Exactly.
at
I know.
this Tuesday the 15th, it's actually been really interesting because bond prices have moved more in certain areas of what we call the curve than what they would typically do. But it's so the way that we frame it is if you have certain buckets of your portfolio, meaning if you have some bonds that are shorter in maturity. So Jay, like as an example, one thing that I often talk to clients about, if you ask me to watch your dog for a day, I'm probably going to say, hey, Jay, can you give me some kibble? And I'll do it. I'm not going to ask you to pay me, but I'll watch your dog for a day. But if you say, hey, Brooks, do you mind watching this dog for a year? I'm going to say, Jay, you're probably going to have to pay me a good bit of money to do that. Like I'm going to need some food. I'm going to need some, you're going to have to pay me some interest. So that's
a big ask, Jay.
Yeah. Yeah. So that's how you can think about bonds, right? The longer that you loan somebody money, the more that you're probably going to demand as far as a payment goes. It doesn't always work that way. But that being said, if you have a shorter duration loans in the portfolio, those shouldn't move quite as much over time. So where I'm getting, without going too far into the weeds, is that we have different types of duration, different types of loans. So government loans, corporate loans where we're loaning to businesses. And that should determine how those prices move. You can't just say, okay, what are bonds doing? Because that can mean a number of different things. But there's a reason why we have a diversified portfolio, whether it's stocks or whether it's bonds, because they should play, specific roles in the portfolio, if you will.
Okay. So, all right. We got a classic buy low, sell high question from Ronnie. Okay. Should we buy more when the market is down? Now we're getting into the advice category here.
Yeah, Ronnie, that's a tricky one. I don't want to give any advice. I think that's going to be based off your situation. But Jay, the one comment that I'll make, I'll refer back to an earlier comment I made, is that if you would have told me, at least for me, 6 months ago, that stock prices would be 20% lower, I would have said, hey, that could be interesting. Now, again, we don't know what the future holds. I have a very long time horizon. So I think it's very dependent on how your portfolio is set up. And if you have those immediate cash needs met, then maybe so, but I don't want to get in the advice realm. So I want to stay away from that.
By the way, our guy Brooks does a blog, Full Court Press, right?
Oh yeah.
And your most recent one just talked about not being able to look in a crystal ball and, trying to guess or beat the market. And it's a tough road, right? Because where is it luck and where is it skill? And so it's a really good blog if you guys can find it on our website. Let me see here. Hold on here. Let me go to this one right here. With prices dropping, what are your thoughts of doing a Roth conversion now?
Yeah, that's one that we have definitely explored with clients. And I don't want to give you the caveat every time that it's based off your situation, but this is one that's really based off of your situation. And I want to leave it to our advisors. But one thing I will say that I've heard from some of our lead advisors is that if we weren't looking at doing any Roth conversions for a client before, we might not necessarily look at doing them now. But if we were already looking at something like that, then now might make sense, holding all else equal, which it rarely is. But if prices are down, again, that can be painful at times for sure. But you want to, when we look at that market downturn do's and don'ts, that was one thing on there that we are examining with our clients. But again, we kept it really broad on that PDF for a reason. And the reason is because even with our clients, we're not broadcasting, hey, we're doing Roth conversions across the board. It all depends on your financial plan that we're putting together. So important caveat there.
Okay, that's great. I wanted to. This is kind of on topic, off topic, but something I hear, right? So, talking to prospective clients, investing, the topic of investments, because Root obviously handles the investments when you come over. It can be sensitive for some people because some people have done it themselves, or some people have hired advisors, and they say, Jay, what's your average rate of return? You know, how can I be guaranteed that you guys are going to do better than my last advisor? That you're going to beat the stuff what the S&P does. Questions like that, right? Market timing questions, rate of returns, and you and I have talked about it, Brooks, because for some people are like, well, I'm leaving my advisor because they didn't do good enough, right, by my standards, and it's really tough because we've kind of, again, we've talked about this, and again, a lot of traditional advisors are focused on one thing, which is investments, right? How do I make your money grow? So that's kind of what they're being graded on, right?
Yeah.
And I have, my answer to that, but I think it's valuable coming from you for clients that are kind of concerned about that, like the rate of return, market timing, things like that. Are you guys, how often are you trading, stuff like that? I thought it'd be a good topic for you to kind of cover.
Yeah. Yeah. Happy to riff on that a little bit because
Yeah,
there's a
just a little
lot
riff.
there, for sure. And what, if you don't mind, Jay, let me see if I can reshare here.
Gonna share something? Okay.
Yeah, if I could share this just briefly. So going back to what we saw here,
Yep.
we do often get the question, or from time to time we'll get the question, what are your projected returns, or what are your return expectations?
Yep.
And any financial plan, I don't want to act like we have some sort of wildly crazy out there, AI driven, et cetera, et cetera. Like
Yeah.
any financial plan that we put together is going to have certain assumptions.
Yep.
That is the case for any good financial planner. But you want to be conservative with those assumptions. We think that's important. And we
Mhm.
also want to make sure that everyone understands these are assumptions. They aren't guarantees. There's no guarantees when we talk about investing. And often when people say, okay, well, what's your target rate of return? Or what's your expected rate of return?
Yeah.
And we might say 10%. This is actually exactly what I share with those folks, is that if you peg me to a 10% return, what I can guarantee you is that the market, at times I'm going to look like a genius because the market's going to return, 20+% in a lot of these years. And then sometimes you're going to say, Brooks, what in the world are you doing? I mean, we're down 22%. And even now we're down 12%.
Yeah.
But the market giveth and the market taketh away.
Yeah.
That is how it goes. And one thing that is really important is when there's so many folks out there, a lot of advisors out there, where their value proposition is investment management, that they can pick stocks, that they can dip and dart out of the market. That's not the game we play. And there's a lot of reasons for why we don't engage in that type of activity. And just to, put a bow on it, the overarching reason is that when you look net of fees, the ability of large investment managers, the ability for individuals to try to pick stocks or to try to outguess the market, to consistently do better with these really high fees, net of fees, it doesn't work out. Net of fees, it does not work out. And also, it goes back to that investor psychology element too, where if you're constantly dipping and darting and trading and getting in and out of the market, one, it's pretty expensive to do that. Just so everybody knows, anytime you're trading in the market, there's a little bit of transaction costs associated. I often tell people, Jay, your portfolio is like a bar of soap. The more you
Yeah.
touch it, the smaller it gets, man. So
I
if
love that.
you're touching it all the time, that
Yep.
bar of soap is going to get a heck of a lot smaller. You're better off just leaving it in the wrapper and never touching it. So at the end of the day, you don't want to constantly be handling your portfolio. And so we are long-term buy and hold investors,
Yep.
but there's also things that we can do, back to our earlier conversation, Jay, around more the planning side that helps us to really achieve the type of outcomes that we want to achieve. So going back to the original point, we don't make forecasts on what the
Yep.
market's going to do for the next year, even the next 3 years or the 5 years. Do we have assumptions? Yes, but we know that there's a lot of variability built into those assumptions. So that's what
Yeah.
your financial plan is based on, is assumptions that have a lot of variability built in. And that's what's so of critical importance. And we're not going to say, hey, we're going to do X amount better than the market on any given year. We're not going to say, hey, let's get out of the market because we don't think stocks are poised to outperform or anything like that. You're not going to hear that type of language from Root, because it's such a difficult and costly game to play if you get it wrong.
Yeah, and I think what's
let me stop that share.
Yeah, I got it. I think what's also important that we've all talked about, and I was educated on this early on, is that everybody comes to us with a different portfolio, right? And everybody comes to us with a risk profile. And I tell people, you got to remember, Root is not here to give you a cookie cutter plan. We do 60-40, and we only use these one or two funds. That's not how it is, right? We are we have a different mentality. We are more safe, passive investment strategy, but we do it bespoke. Ari always says we have no cookie cutter approach. Everybody comes to us with a different portfolio and different wants and needs, right? That we're trying to solve for. So, for example, I tell people we just seem to have a niche of tech employees that have a lot of their net worth in concentrated stock positions, Nvidia, Apple, whatever it is, right? And then we have a lot of people that come to us with just a lot of their net worth is in their 401k, or maybe some low cost effective tools like Vanguard, and they've just been seeing good moderate returns, right? Versus people that are highly concentrated in stocks have seen crazy returns. So it would be hard for us to say, oh, here's our average rate of return, right? Or targeted return. So it's really kind of bespoke to the individual client and the plan that we put for them. Does that sound pretty fair, Brooks?
Yeah, that is totally fair. And that's the other really important caveat. And yeah, I didn't I didn't want to hand the audience another, hey, it depends on your financial plan, but I totally agree with you, Jay, because anybody that comes to Root, I think I shared this one with you. It's kind of like you're on a road trip, right? And we haven't been with you the entire road trip. You had different starting locations. Some people started up in Massachusetts, some people started in Florida, some people started in North Carolina. And if we're playing the role of like a auto body shop in the middle of the country in Kansas, well, everybody has had a different route to meeting their Root advisor or having that kickoff call or having that Sequoia process. And so what you come in with is going to be a different set of circumstances for each individual person. And we have to work around what are you coming in with from an investment perspective? What are your hopes and dreams? What are your goals? Let's explore those. And then we have to put together a plan, investments and everything else, to meet that objective. So that's why, we often, it kind of feels like at times we say this over and over again, but we're different just from the standpoint that we start with the financial plan. What are you trying to get out of life? What are you trying to do with your life? And then that informs the investment allocation. It's not the other way around where we're pushing product, because we're not beholden to anybody. We can use any money manager out there that we think is going to benefit our clients. And so that's what we do. That's a big part of what I'm doing on a daily basis, is having those conversations, looking at those various investments that are available out there in the universe, and then saying, hey, Brandon or Chelsea or whoever, this is the best couch that you can put in this client's house, to use Ari's analogy. This is the best window that you can put in this client's house based on their situation. And everybody's house is going to look a little bit different. And that's the way that it should be. So no cookie cutter approach. And we have to take at times what folks give us and work around it. And that's great. That's what we enjoy doing each and every day.
Yeah, that's well said, man. I appreciate this time, Brooks. The knowledge bombs that you drop are always incredible. I've learned so much from you. I just really appreciate the engaged, like the proactive approach that you do, and you share upon with all of us and come in the community. I would strongly recommend anybody listening out there to join the Root Collective. It's a free community that we've created, and experts like Ari and James and Brooks are on there and giving feedback, answering questions. Get involved. And also, if you want to hear more from Brooks, Ari did a great live with him a couple weeks back where he talked about our investment philosophy. So you can hear and learn more from Brooks there. He's got the blog post on our website. Subscribe to that. He's active on LinkedIn. So if anybody's looking for more truth and advice and knowledge based on that, any closing statements, Brooks? Like, what do you want to leave us with?
Hey, well, Jay, I appreciate you having me on, and it's always fun to talk with you because obviously you're having a lot of conversations with the folks that are meeting Root for the first time, and those are the questions that are really interesting and top of mind for a lot of the people on the call here today. The other thing, I agree with Jay that, hey, if you want to check out it's called the Full Court Press newsletter or blog. It's on our website. That's a lot of fun for me to put together. That's every 2 weeks on Mondays, that you can check that out. And as far as closing thoughts, I just want to circle back to the initial comment that I made around, when markets go down, there's no doubt that it can be painful. It can be emotional for people. But at the end of the day, a lot of it is about trying to disentangle emotions from your investment decisions. And that's what we're coaching clients through all the time. So before you make any any decisions, before you try to change anything, reacting to your finger being on the stove, I would just encourage people to think through, hey, when the time comes to buy or when the time comes to hold, I know that I won't want to. It's just human nature. See if we can rewire that, reframe that, and I think you'll be a little bit better off for it. Again, not trying to give broad investment advice, Jay.
Yeah.
But no. I think that keeping that in mind is really important when you start to think about investing decisions and emotions getting involved. It can be really tricky.
Yeah, I think it's just so important, and I hear from it, and I feel for people. I mean, I use my mom as an example, and I get it. Like, you're trying to retire, stuff like this happens. You're not, maybe you haven't planned for it, or you're not used to it because you just got in the market, and it's scary. And I have so much empathy for that because I feel it, and I'm, unfortunately, I'm nowhere near retirement, but I feel it, right? And so for people that are trying to make that step, so I thought this conversation was really important. I was really excited to have you on, and I just really appreciate you taking the time to do this, Brooks. By the way, I just put in the latest edition of his blog in the chat, so guys, check that out. You can find us on the Collective. You can reach out to us there. But other than that, I hope you guys are doing great. We're always here to answer questions. Thank you guys for listening, being engaged participants, whether it's these live streams or the Collective. And we are wishing you guys all the best and confidence to come. All right.
Yep.
All right. Thanks, Brooks. Bye, everybody.